Hello everyone. This is the last slide of previous movie. Yes, this is last slide of previous movie that presenting or explaining the final goods and final goods or final services. The other one intermediate goods or intermediate services, and last one capital goods. So in economy in one country, goods services that used by users could be split into or could be divided into three types or three groups of goods. Okay, the first should be final goods or final services. Second one should be intermediate goods or intermediate services, and the last one capital goods. So they are already explained from a previous movie. Final goods, the values or market values of final good count into GDP. The market values of intermediate goods or intermediate services are not counted into GDP. For capital goods, the market values of capital goods will count into GDP at current period or current situation. What does it mean current period? That means the period that or the period of time that these capital goods are produced. They refer to the period that these capital goods are produced. That's why the year or the month or the quarters or month semester that these capital goods are produced, the values of this capital good will count into GDP at that year or that month or that quarter or that semester. But capital goods can be used for long life or long time. So beside the year that these capital goods were used, the other year we cannot count the market values of this capital good into GDP. Okay, so be clear for that one. Currently counted as a final goods. If currently counted as final good, that means market values of capital good count into GDP at this year, current year. Okay, this is the other point, a new one for this chapter, for this movie. Is about value added. Okay, it's about value added. Value added in our language, đầm lại bằng time. Value added for any firm, any production, refer to the market values of its products or service minus the cost of inputs purchased from other firms. So value added refer to the values of product. I can say that values output. This is market values output minus the values of some input. Some input, not all input. Okay, the value output minus some input. This input that company buy from the others in order to produce. Normally, this some input refer to raw material. This some input refer to raw materials. Okay, so value added refer to value added. The values output that company produce minus the values of some inputs that company buy from the other firm or the other companies. That's why the value added values output minus the value input. Market value, this is market value. Okay, the value here is market value. Output minus input, but not all inputs, some inputs only. So if you find one company, one market value, the other company also the market value. If your country has 100 company, that's why you need to find 100 value added. So when you add all these value added together, you will get GDP by production. So in order to define GDP by production, you need to find the value added from all productions, all stage of production. And then you can add those value added together. You can get one value. This value we call GDP by production. Okay, we go to example. For example, for bread production, company we use revenue that is received by this company minus cost that paid by this company in order to produce output. That's why value added in this case revenue minus cost of input. We're talking about bread production. Okay, and so first we look at wheat. Farmer produce wheat and then selling into the market. So in order to produce wheat, we suppose in this example that farmer owned everything by themselves in terms of input. Farmer have seed, has water, have tractors, have labor, have land, have fertilizer. That's why everything in terms of input for producing wheat, farmer has their own. That's why farmer don't buy from the others. If farmer don't buy from the others, that means the cost of input is zero. Suppose that farmer produce wheat and sell this wheat into the market 50 cents. So revenue or the values of output in terms of wheat 50 cents minus cost of input, but cost of input is zero. That's why value added for farmers in terms of producing wheat is 50 cents. Flour production, in order to produce flour, they need materials or input. The material or input that flour production need to is wheat. That's why farmers sell wheat to the market 50 cents. Flour production owner will pay 50 cents to buy from farmer. When they got wheat, they take into milling machine and then they got flour. So when they got flour, they sell this flour into the market with the revenue revenue $1.2. So $1.2 is the revenue of flour production owner, but it's not all belong to flour production owner. It means flour production owner cannot take this money into their pocket because this amount of money also including input. That means flour production produce their own activity only 50 cents. 70 cents. Okay, how to get 70 cents? To market values of output minus market values of input. Bread production, in order to produce bread production need flour. That's why flour production owner produce flour and sell into market 1.2. Bread production will buy this flour, paid 1.2. Okay, paid 1.2. So bread production get flour from flour production, they produce bread. When they get flour, they can produce bread. They produce bread and sell it into the market with revenue $2. So $2 is revenue for bread production or bakery production, but bakery production owner or bread production owner cannot take this $2 into their pocket. Why? Because this $2 also including inputs. That's why in order to find the activity that performed by or done by production bread production owner, we need to take some cost or input away. So $2 take $1.2 away, we got 80 cents. So this is value added. Value added of farmer come from total output of farmer minus total input of farmer, but total input of farmers is supposed to be 0 because farmer owned everything by themselves. Value added for flour production, total value total market values or output minus total market values or input. And bread production, total market values or output minus total market values or input. So because in order to produce bread production, we have 3 stages of production: wheat production, flour production, and finally bread production. That's why in order to find bread production, we need to add all these value added together. So $2 is it can be said that $2 here refer to GDP for bread by production approach or by production methods. Okay, by production approach or by production method. $2 come from the value added from farmer 50 cents plus value added from flour production 70 cents and plus value added of bread production. That's why in order to define GDP by production, you need to calculate value added from every production or every stage of production, and then finally add them together. You will get value added, total value added. Total value added is GDP by production. So in this example, we can say that $2 is GDP for bread production. $2 is GDP for bread by production approach or production method. Okay, go back to textbook. You can practice example 17.4 and 17.5 on page 446. Okay, you have textbook. You can go to this page and you can see examples. Just this one. Example 17.4 is about barber and his assistant. 17.5, a good that can be either intermediate or final goods. Okay, you have textbook, go to that one. This is the other example of ice cream production. So in order to produce ice cream factory or production owner need to buy material from farmer. And again, we suppose that farmer owned everything by themselves. That's why farmer don't buy any input from the other in order to produce the material for producing ice cream. Okay, so you can see this one. The value added for ice cream is 500. Total value added for ice cream is 500. But actually, this is not only production. This one production, farmer produce, output and sell into market $100. we suppose that farmer own everything by themselves. So the value added for farmer $100. Factory owner, in order to produce ice cream, factory owner need input. Input must be from farmer. If farmer sell into market $100, that's why ice cream owner must pay $100. And produce ice cream selling into market 250. So the value added, or the market value for activities of ice cream owner is only 150. This is not really production, this is service. Middlemen, they buy ice cream from producers and sell it to vendor. Vendor, it means retailer. This is a little bit wholesaler or middle person. Buy production from ice cream from buy ice cream from production owner and sell it to vendor or retailer 400. That's why the activity produced by middleman or wholesaler 150. Retailer or vendor paid 400 to wholesaler or middleman, and selling to users, total revenue from selling this ice cream to users 500. That's why retailer or vendor produce activity equal to $100. So when you add all value added of this state together, we got 500. 500 must equal to the price of the last stage. Okay, so in order to get $500, we add all value added together. So $500 is GDP by production, and GDP by for ice cream production. It's not 1,250. If you count, or if you think, or if you consider 1,250 as a GDP for ice cream, this is wrong. Why it's wrong? Because 1,250 is double counting. Okay, what does it mean, double counting? For example, 1,250 come from 100 plus 250 plus 400 plus 500. In terms of 100, for the first stage of production, farmer is okay. Yeah, you can count it, but you cannot count 250 as the value that ice cream owner produce. Ice cream owner produce or perform activity, produce the output, but the activity not really 250. If you count 250 into GDP, 250 is double counting. How can I say that 250 for this one is double counting? Because 250 including 100. Okay, 100 here also going to 250. If you count 250 into GDP, 250 count 100. But in terms of farmer, they also count 100. This is the same thing, the same amount. Why we need to count 2 times if it is only 1 time? So 250 is double counting. Double counting, that means count 2 times. Why 250 count 2 times? Because if you consider 250 to be part of GDP, 250 count 100 one time for its own stage, but this 100 count the other time for the previous stage. That's why we cannot count 250 into our GDP, because 250 count 2 times in term for 100. Okay, that's why value added is the best way. So in this case, the value that produced by ice cream producers or maker is only 150. Take the the farmer value away. Take the farmer value away from our production of for ice cream, the owner of ice cream. Okay, so the other one, for example, 400. You cannot count 400 into GDP because inside 400 it has 250. If you count 400 into GDP, 250 here count, and 250 here also count. Okay, it's all count. How to get 250? 250, 150 for production owner and 100 for farmer. That's why if you count 200, it's double counting because 250 count 2 times. Why is it 2 times? Because this one is 1 time and this one is the other time. So, in order to avoid double counting for calculating GDP, we use value added methods. Okay, that's why every stage of production or every production we need to find value added. And we count these value added together, we will get GDP by production. So don't count the value of output into GDP because the value of output also including the values of input. So a value input is not belong to this producer, belong to previous producer. That's why take value of input away from this producer. Okay, so this is, don't count values output into GDP because value of output is double counting. Instead of counting value added, instead of counting values of output, we count only value added from every stage of production. Okay, you can go to, yes, based on your textbook, you can go to concept take 17.2 on this page. Okay, so these are the methods that we use in order to calculate GDP by production. But I just provide you a little bit brief explanation because in order to study macroeconomics, computing GDP, we use only one method, not production, not income, but expenditure. So in an expenditure side, I will talk a little bit more detailed than production side. So production side just introduce you how to find value added of how to find GDP by production. Just a very brief. That's why sometimes you cannot get all concept from that one. Okay, produced within a country during a given period of time. Produced within a country, what does it mean? Only production that take place inside a country border that we count into GDP. Because GDP is total market value of final goods or final services. Final goods, final services come from production. Okay, so produced within a country, it means that all productions that happens or that takes place, all production that take place inside one country border, the values of this activity of using count into GDP in these countries. Okay, in order to be clear, we can see example. For example, for Cambodia's GDP, in order to compute or in order to calculate GDP for Cambodia, let's say, yes, Excelida Bank is originally owned by a Cambodian investor. Suppose that Excelida banking services produced in Cambodia by Cambodian-owned bank are counted into GDP. That's why the market values of banking service produced by Cambodian owned bank inside Cambodia count into GDP for Cambodia. Okay, this activity produced inside Cambodia and owned by Cambodian, so the market values of this activity count into GDP. Mekong Bank services produced inside Cambodia but by foreign owned bank, because this is not originally invested by Cambodian. This is from Malaysia. Okay, Mekong Bank from Malaysia. That means Mekong Bank from Malaysia but located in Cambodia produce banking service in Cambodia, but originally owned by a foreigner. The market values of this banking service from Mekong Bank also count into GDP in Cambodia. Why? Because this activity produced inside Cambodia, consumed inside Cambodia. It doesn't matter produced by Cambodian investor or foreign investor. So GDP is about domestic production that happen in domestic count into GDP. The market values of this production or this product we count into GDP. So for example here, banking service produced by Expenditure Bank in Cambodia. Expenditure Bank invested originally by Cambodian, we count into GDP. The market values of banking service from Mekong Bank that produced inside Cambodia but originally owned by foreigner, we also count into GDP. The other one, Expenditure Bank produced banking service but in Laos, not in Cambodia. Expenditure Bank produced banking service and supply in Laos, but Expenditure Bank originally invested by Cambodian. So in this case, the market values of banking service of Expenditure Bank in Laos not count into GDP in Cambodia. Okay, so this is you need to understand within a country. Within a country, it means domestic. So every economic activities that take place inside one country, the values added of these activities must count into GDP for that country. Okay, so for example, this one I'm using banking service because Expenditure Bank originally invested by Cambodian. Okay, by Cambodian. So maybe you have some question for that one. This is in order to be clear for within a country. And during a period of time, it's easy. You need to have beginning point of time, ending point of time. That's why this is a given period of time. Normally, for example, 1 month, maybe the beginning from the 1st January to 31st December. This is one year period. Okay, so in this slide, explaining you about within a country. Within a country, it means domestic. So in Cambodia, activity produced in Cambodia, owned by Cambodian investor, count to GDP. Activity produced in Cambodia, owned by this activity owned by foreigner, also count into GDP. Activity produced outside Cambodia, even though this activity owned by Cambodian, not count into GDP for Cambodia. Okay, so this is must be clear. Okay, again, go to your textbook, open this page 448, 449. You can see examples 17.6 concept check 17.3 and recap. Recap the mean review. Review what we have done from the first point of chapter. Okay, we can go to this one. This one, point 8. 17.6 on page 448. Okay, you can see this one and you can study and you can answer this question. And moreover, you can go to example here. The sales of house and GDP. Okay, so you can go to study this example and recap. Okay, oh, we still have point 3. This is a concept check 17.3 and recap here. Yes, this one, recap. Measuring GDP. So gross domestic product equals to market value. So we have 2 points here to read. Of final goods. Final good, in terms of final good, they also explain 2 points here. Produced inside a country in a period of time, 2 points here. Okay, you can go there to see. GDP equal to market value of final goods services produced or consumed inside a country border, province border, city border, state border during a period of time. Okay, so practice this one. If you have some question or some problem or some points unclear, you can contact me. Okay, and so we have looked GDP by production. In order to define GDP, in order to calculate, in order to compile, in order to compute GDP by production, we need to find value added from each production or from each stage of production, and then add those value added together. This is GDP by production. Okay, previous method is GDP by production. In the market, every good or every service that is produced must be purchased. Okay, must be purchased by users. For example, if the country produce consumer goods, this consumer good must be used by consumers. What are consumer goods? There are a lot of there are a lot of consumer goods that are available in our market or in one country's market. If the country produces capital goods must be used by company, not by household. Consumer here refer to household, this is a company. Okay, if the country produces government good, must be consumed by governments. Okay, government goods. Maybe consumer goods refer to final goods or final services. Capital good I also explained previously, but not yet a government good. Maybe you can ask, what kinds of good can be government good? Government goods refer to public goods. Okay, government good refer to public goods. The good that used by public person, public people. but paid by government. For example, road that built by government, that owned by government for anyone to use. Okay, but owned by government, anyone to use. This is we call governmental road, a governmental good, because government pay to buy this or to construct these goods, but used by public people. But sometimes government build a building, but not for public people. For example, building ministry that's only used by the government itself, not by public people. Public people. So in this case also we call a governmental good. So measuring market values of production is similar to measuring the money value of expenditure. Here is expenditure method for measuring GDP. This is production, this is GDP. Okay, if we produce goods, we need to pay for production. However, this good must be used by the other people. The other people must pay to buy. That's why they are expenditure. So production expenditure. According to the expenditure side or expenditure methods, GDP can be compiled, can be computed, can be calculated as this formula. This is very important for study macroeconomics. In order to study GDP calculation in macroeconomics, they clearly mention only GDP by expenditure method. Okay, so GDP by expenditure come from C plus I plus G plus X or NX. And X is X minus M. What is C? C is household consumption expenditure. Household stand for final users, ultimate users. It means that C is consumption expenditure by household. I is investment expenditure by investors. Okay, by investor. This investor including, for example, in Cambodia, investor including Cambodian investor and foreign investor, but this foreign investor invest or run business in Cambodia. So I here including investment by Cambodian people and investment by foreign people, but these foreign people inside Cambodia. Okay, that's why I gross it means total. Gross private domestic investment. Total of Cambodian and foreign investment together. But foreign investor here must located in Cambodia, if talking about Cambodian GDP. G is Cambodian government spending or expenditure. NX is net export. Net export comes from export minus import. X is export, M is import.